Hello everyone. Let me first congratulate all of you with the start of the week 2 and also with the successfully completion of the week 1 materials. And week 2 will be dedicated to the corporate finance as it was promised before. So this is mainly about the introduction part, and as I said before, we're not going too deep into the corporate finance because this is the pre-ACCA, pre-CFA course, and that's why we mainly talk about like main parts and basis of the corporate finance in this class. So let me move on to the next slide. So what let's imagine that you open a cafe during the week 1. We have opened the cafe, our business, and we have like worked for several months and we generated profit. And let's imagine that you want to sell that, you sell a business or expand it or open some branches or invest into it. Okay, but think about how you're gonna like measure the value. How do you decide what it is worth today? Or how do you decide it's good business or bad business? Or how do you know is it worth investing? So in this for this type of very important questions, the corporate finance will help us to answer. So corporate finance will help you to decide whether the project or business is worth to invest, worth to like buy or acquire. So corporate finance has a lot of tools, this kind of like net present value, internal rate of return, weighted average cost of capital, and also in this semester we're gonna like build discounted cash flow model where we're gonna like value our acquisition company project. Okay, and also we also talk about the P, price to like earnings ratio, which is called the multiplier method of valuation. And also we talk about the dividend growth rate, dividend growth model, assets or book value method. And also we will talk about how we're gonna calculate the markup, the company's value according to its markup. So, what is a corporate finance in the first place? The corporate finance is a division of finance that deals with how corporations deal with funding sources or capital structuring, for instance, or investment decisions. The corporate finance is primarily concerned with maximizing shareholders' value through long-term and short-term financial planning and the implementation of various strategies, goals, and by using the various business valuation methods. Corporate finance activities range from capital investment, decision making, and investment banking strategies. And also, corporate finance consists of several important blocks. First block is the corporate governance block. So, all the experts in this field, in finance field, should understand the idea of a firm stakeholders, how conflicts can arise between stakeholders, and how effective corporate governance can mitigate these problems. Also, important points are the election of the board of directors, the board's duties, and important factors in board composition. And also, this kind of like corporate governance block can explain us the rationale for incorporating environmental, social, governance, and other factors that portfolio selection practice presented. And also we have the capital budgeting block. The capital budgeting block mainly talks about the uh, investment. It mainly talks about the identifying and evaluating the capital investment projects, and we have the cost of capital where we're gonna like evaluate and estimate the cost of our financing resources such as debt financing and like equity financing. Debt financing, it can be loan, it can be bonds, and different types of notes, okay? And also in equity financing, we'll talk about the shares, cost of shares, and etc. And we have the leverage block. Leverage block is very important in corporate finance, and that's why we're gonna like focus on this um, separately. And also we have the dividend share block, and also it is one of the like important pillars of the corporate finance. And at the end, we gonna like focus more on the working capital management. So let's move on to the corporate governance. Okay, so what is we have already talked about what is a corporate governance? So corporate govern in order to understand the corporate governance, I have to mention about the shareholders theory. Shareholder theory, the primary focus of a system of corporate governance is the interests of the firm's shareholders, which are taken to the maximization of the market value of the firm's common equity, like shareholders' equity. Under this theory, corporate governance is primarily concerned with the conflict of interest between the firm's managers, the directors, and its versus its owners, with its owners, right? Which means with the shareholders. So this conflict between the managers, directors, and the shareholders are very important to understand in order to avoid this in your company, in your organization. And also, so what is a shareholders? It's someone that has a residual interest in the corporation, in that they have claim to the net assets of the corporation after all liabilities have been settled, right? So in our equation, assets equals to equity plus liability, though the shareholder part is the common stockholders part, okay? Owners, not retained earning, but the owner's equity part. And we have the shareholders акционеры, да, на русском. Также у нас есть, and also we have the board of directors. They has a responsibility to protect the interests of shareholders. Совет директоров, да, to hire, fire, and set the compensation of the firm's senior managers, to set the strategic direction of the firm, and to monitor financial performance and other aspects of the firm's going activities. So we have this board of directors mainly consist of the like top management of the company, senior managers. These senior managers typically receive compensation, which means remuneration, that is made up of a salary, a bonus based on some measure of company performance or prerequisites. Okay, their interest can be expected to include continued employment and maximizing the total value of their compensation. Okay, so here is the main important thing why the conflict between the shareholders and managers occur. It is because shareholders are interested in increasing their value, and managers are interested in increasing their compensation. Okay? То есть акционеры, они всегда заинтересованы to increase, да, улучшать свои позиции. Когда как топ-менеджера, вот, директора, управляющие директора компании, они, они в основном они заинтересованы, чтобы, чтобы в увеличении своих зарплат и бонусов квартальных, там, ежегодных и так далее, да. And we have employees. Employees, то есть сотрудники, да, also have an interest in the sustainability and success of the firm. They have mainly an interest in their rate of pay, opportunities for career advancement, training, and working conditions. Yeah? В основном так. And we also have the creditors, which supply debt capital to the firm and are primarily owners of the firm's outstanding bonds and banks that have made loans of the firm. Это банки, да, и финансовые, такие, а также другие финансовые институты, которые нам дают кредиты, да. And also we have the suppliers. Supplies resources to the firm, have an interest preserving on an ongoing relationship with the firm. Наши поставщики, да. So this principal agent conflict between shareholders and managers are always like will be and that's why we have to like understand and try to solve and prevent it from happening in your business. Okay, let's talk about now about the capital budgeting. So we said that the capital budgeting is a process of identifying and evaluating capital projects where the cash flow to the firm will be received over a period longer than a year. And that's very important, right? To understand. Any corporate decisions with an impact on future earnings can be examined using corporate finance tools. There are a lot of tools which I have mentioned. It is net present value, it can be IRR, it can be weighted average cost of capital, period of payback period, and it can be like discounted cash flow and etc. This kind of like things, instruments of the corporate capital budgeting. So where we need the capital budgeting? When we decide to buy a new equipment to the company, or when we decide to expand our business, okay, by using equity and debt financing, and also when we decide to move or expand business to other locations different than its original establishment place. And also, for instance, it can be to replace the delivery truck and etc., right? So we have to understand uh, four processes, administrative steps. First one is the idea generation. It is the most important step in the capital budgeting process, where we generate the project ideas. Ideas can come from a number of sources, including the senior management or functional divisions, employees. It can be the sources outside the company, research from the research and development department of the coffee company, etc. So it is one of the most important parts to receive the correct, right, and ideas projects. Second step is analyzing the project proposals. This decision, because the decision to accept or reject a capital project is based on the project's expected future cash flows. Okay, a cash flow forecast must be made for each product to determine its expected profitability. The third step is to create the firm-wide capital budget. Okay, firms must prioritize profitable projects, and you have to like omit the unprofitable ones. Step 4, monitoring decisions and conducting a post audit. It is very important to follow, monitor, and evaluate every project that was like being implemented, that are being implemented. Okay, you have to like keep in touch with your like project department of your company and ask, and you should be interested why it is being like implemented, why it is being stopped, why it is being slowly implemented, and etc. And if the costs and that if the additional costs like occurred during the project implementation, and you have to like also monitor these kind of things. um, so categories of capital budgeting projects can be replacement of projects to maintain the business, replacement project for cost reduction, and expansion projects, new product or market development, mandatory projects, and other projects. Okay, so in this kind of like projects, we are gonna use the capital budgeting tools and instruments. 5 key principles in capital budgeting. Decisions are based on cash flows, not accounting income. Okay, in capital budgeting, we don't mainly look to the income statement, but we evaluate the discounted cash flow. Cash flows are based on opportunity costs. So we always look for the other sources. For instance, we have $1,000 and our project has to bring more values than our alternative like project ideas. Okay. Third, the timing of cash flows are important. So today's cash flow is more important. Today's cash is more valuable than tomorrow's cash. So $1 today is not equal to $1 of tomorrow. That is main golden rule of the capital budgeting. And four, cash flows are analyzed on an after-tax basis. So we don't need. We are interested as corporate finance like managers. We're interested in after-tax value of our like cash flow. We don't evaluate the part that we are giving to the government, and it is not important because we are not receiving any value from that cash flow, and we are interested. That's why we are interested in only what we are receiving after tax. Uh, the last principle is financing costs are reflected in the project's required rate of return. Okay, so first tool that we're gonna talk about today is the net present value. Net present value is the sum of the present values of all the expected incremental cash flows if a project is undertaken. So, in order to understand if the project is worth investing or not, we have to like calculate the net present value. As you can see from the slide, here is the formula for the net present value. It is about the cash flow. Zero is it is the initial investment outlay. So it is the like initial in our investment. If we are going to invest in our like project $1,000, so we have to like indicate at the CF0 1000, and the next CFT is after tax cash flow at time t. If your project we're gonna last 5 years, if your project we're gonna if you're going to evaluate your project for 5 years or 10 years, and you have to like accordingly indicate in this part, k is the required rate of return for the project. So NPV rule, if the NPV is positive, we are undertaking this project. Okay, which means that it is expected to increase shareholders' wealth, and we can accept it. If if your NPV is negative, which means that it is expected to decrease the shareholders' wealth, we're gonna reject that. If the NPV is zero, has no expected effect on shareholder wealth, and also it is not it also should not interested us. Okay, so let's do some example. Using the project cash flows presented in table 1, you have to compute the NPV for each project. So there are project A, project B. Initial outlay for both projects is 2,000 United States dollars. In year 1, this project will generate us $1,000. Project B generate us $200, and in 2 years, this project A generate us $800,000. Project B generate us $600. In year 3, our project A generates $600, project B $800, project in year 4, project A generate 200 and project B will generate 212. Okay, let's look at the answers. We like before I have like demonstrated shown you the formula of the NPV, and here from project A, we received 157.64 and from dollars, and from NPV B, we have after investing $2,000, we have after 4 years we have received $98.36. So you have to clearly understand we're gonna receive these amounts on top of our initial outlay. So your total value will be 2000 plus 157 and 98. Okay, so both projects A and projects B have positive NPV, so both should be accepted according to the rule of the NPV. And the next, it's the internal rate of return. For a normal project, the IRR is a discount rate that makes the present value of the expected incremental after-tax cash flows just equal to the initial cost of the project. IRR is a discount rate that makes the present values of the project's estimated cash flow and cash inflows equal to the present value of the project's estimated cash outflow. That is, IRR is the discount rate that makes the following relationship hold. Your inflows should equal to the outflow, okay, when calculating the IRR. That's why the NPV takes when we're calculating the IRR, we always take the NPV as a zero. The same formula, but NPV will be equal to zero. So IRR decision rule. First, determine the required rate of return for a given project. This is usually the firm's cost of capital, for instance. Note that the required rate of return may be higher or lower than the firm's cost of capital to adjust for difference between the project risk and the firm's average project risk. If the IRR is higher than the required rate of return of your project, then you have to accept the project. If the IRR is lower than the required rate of return, then you have to reject the project. Okay, let's look at the example. The same table, the same numbers, same projects that we have used to calculate the NPV. So the answer will be, so after calculating, after making the NPV zero and putting the cash flows and making the IRR for unknown, we received the IRR for project A 14.48% and IRR for project B 11.79%. Both projects should be accepted since the IRRs for both projects are higher than 10% required rate of return. Okay, so in this example we received our required rate of return for the project is 10%. Okay, and also there is a payback period. The payback period is a number of years it takes to recover the initial cost of an investment. So the formula for the payback period is full years until recovery plus unrecovered cost at the beginning of the last year divided by the cash flow during the last year. So example, same projects, okay, same projects as we used to calculate the NPV and IRR. Okay, so in we're gonna like invest, our initial outlay will be 2000 USD and cumulative net cash flows will be in the first year is negative $1000, in a year two negative $200, in year three $600, in year four 600, and you can see the numbers for the project B as well. So we're gonna like for project B, our payback period is 2.33 years, and for the project B our payback period is 3.33 years. So according to the payback period, project A is more like acceptable, and because we're gonna like receive our initial investment during only in 2.33 years. And this is it for today, and next we will talk about the weighted average cost of capital and other tools of the capital budgeting. Thank you, stay tuned.